Thanks a lot for being here with us. Lucas, please.
Okay. So be very welcome, guys. Thanks for joining this webinar. And also thank you, Diogo, for this presentation and for the introduction. Okay, so I'm going to share a presentation here. Just a moment. All right, Diogo, can you see my presentation?
Yes, it's appearing for me. Yes, that's okay for me.
All right, thank you. Okay, so we are going to talk today about building an ALM and balance sheet optimization model. Okay, so this is being created from a book that we have released last year, and also from a course on ALM and balance sheet optimization that we have been given. And we are going to give more details about how can you treat the ALM problem mathematically and using optimization models. Okay. So our agenda today is going to be first a presentation of our background. Then we are going to talk about what a balance sheet model is, right? Then we are going to present a use case. We're going to talk about the technology that we are using to solve this case. And then we are going to showcase some of the results of the model, okay? All right, so Diogo and me, we have been for a decade or so in banking, right? But we have a background in computer science, in economics, and also engineering. So joining those skills, we have released the book ALM and Balance Sheet Optimization, and also a course in our company, which is called Financial Risk Academy, right? So this is the course we have released this year, and also we are going to present some of the features that we teach in our course. Okay. All right. So a balance sheet model. The main results of a balance sheet model, of course, is the projection of financial statements, right? So we are talking balance sheet, cash flow statement, income statement, and also other reports. We have also the product of an ALM model is also some additional reports like capital ratio reports, all the risk metrics for trading and for banking portfolios, profitability reports, and all sorts of tables, charts, and dashboards. Okay, so another product of the ALM model is the investment strategy, the hedging strategy, and also the funding strategy, right? So we think that a good ALM model should handle those strategies in the most granular level, right? In a level that is implementable by the teams, right? So we have to make the model take optimal decisions, not only in terms of risk factors, but also in terms of what instrument should I invest in, right? With what maturity, what indexes, currencies, what is the accounting classification, and also pricing. And if we are talking about a multi-period model, right, which has multiple stages of decision, we also have to decide what is the timing to enter in that deal, right? So a mathematical model, it will optimize the allocation of assets and liabilities, right? Always aiming to a financial objective, and also constrained by all the regulation and all the business rules that a financial institution is subject to, okay? All right, so main applications, these are the most common applications. This is not an exhaustive list, right? But some of the main applications of an ALM system is to stress test, right? Be a top bottom-up stress test or a or any kind of stress test, right? And also capital assessments, right? Like ACAP, ICAP, sorry. Also the feasibility study of business plans, right? So if you have a new product, or if you want to change an existing product, you can test on an ALM model. You can project what is going to be the outcome of the change in your business plan, right? We can also assess liquidity risk, right? So be there regulatory exercises or internal models, you can also test them using an ALM model. And by doing that, you're going to get the full picture, the integrated results of your liquidity policy, okay? We can also use an ALM model to assess your hedging strategy. So you can test whether it is optimal to do back-to-back hedging or to do ALM hedging, and what are the decisions that we are going to take in each one of those two cases, right? I think one of the most interesting applications of an ALM model is the calculation of the optimal funding mix, right? So you can whether you want to minimize funding costs or you want to also minimize risk. So you can use the model, and you can use the optimal decisions produced by the model to verify what is the optimal funding mix for your financial institution. Also, another important case is FTP, right? So you can also use the results of the optimal funding mix to price your products and do that in an optimal way. Okay. All right. So this is the use case we are going to present today. I'm going to present the data from a fictitious bank, right? And we are going to see some of the constraints that we are creating in this problem, and then we are going to see some of the results that the model produced. Okay. All right. So we have a balance sheet of 2,000 units, right? It could be 2,000 euros, and a liquid assets of 275, 2,100 of liabilities that is distributed into 6 different products, 155 in equity, right? So the bank has 6 different sources of funds, and also 4 different business lines, and also a liquid assets portfolio to manage, okay? So this is a breakdown of the loans portfolio, the banking book. So we have basically mortgages, corporate loans, government loans, and consumer loans. So mortgages, they are longer term, but they are highly collateralized. So they have a lower risk weight in terms of capital consumptions. And the other ones are a mixture of fixed and floaters. And also we have foreign exchange risk arising from corporate loans and from government loans. And all the banking portfolio is being held to maturity, is being classified as held to maturity and evaluated using the amortized cost method, okay? And the new business, the new volumes for these portfolios are going to be determined by a demand elasticity curve that we are going to see later. All right, so in terms of liabilities, we have 6 different products. We have non-maturity deposits here, savings, which is an important source of funds in our example. We also have time deposits, certificate of deposits, right? So these 2 are demand driven. So we are also going to have demand curves for those 2 products. The other one, they are governed by ad hoc rules, right? So we have rules to govern bonds, commercial papers, interbank funding, and also repos, right? And the operation, the natural operation of this bank implies a certain level of maturity transformation and generates, of course, some interest rate risk in the banking book. But we also have the option of issuing bonds with a fixed rate and also with long term, so we can mitigate that maturity transformation by issue bonds, right? Or we can do that by using swaps, by using derivatives to mitigate risk. So this is a trade-off that the model is always looking at, whether I should fund in the short term and use derivatives to mitigate risk, or whether I should fund in fixed rate in long term, and then I don't need so much of derivatives to mitigate risk. Okay, so this is a decision the model is taking in every step, in every place of decision. All right, so in terms of market data, so we are giving the model, we're supplying the model with prices, with curves. So this is the ECB yield curve that is being supplied to the model. And we are also supplying demand curves. So these are only two examples of demand curves that are being created. So this is, if we take a look here at this axis, the zero here is the fair FTP price of a product, right? And these numbers here are, they mean the overlay. So the amount that we add, the amount in basis points that we add over the fair FTP price, and the different volume, the different demanded volumes for each one of the products. Okay, so in terms of funding, if I'm giving more, if I'm giving a higher rate to my depositors, so I'm going to capture more of the market share of the demand for certificate of deposits. On the other hand, if I'm charging more for my clients, right? So I'm going to have a less share of the market for in the demand for loans. Okay, and just something more. So if we are working in an equilibrium model, in a simple equilibrium model, so the equilibrium would be obviously here, right, where the demands for funding meets the demand for loans. But in this case, we are using multiple curves, right? So we have multiple curves for funding, multiple curves for assets, and we also have the constraints, right? So maybe using an overlay of 20 for loans and for CDs is not an optimal decision, and maybe it violates some of the constraints, some of the risk constraints, some of the liquidity constraints. So we are doing a constrained optimization here, so the equilibrium price is not necessarily here in the encounter of those two curves. Okay, so this is just a disclaimer. All right, so now we're going to explore some of the main business rules that we are inputting to the model, right? So this is for the asset side. So the demand for loans is calculated using these demand curves, right? These elasticities. We have business rules for ACL levels, right? For defaults, for prepayments. So these are all encoded into the mathematical model, right? These levels of prepayments, these levels of default. Also, we have a rule for a liquidity floor, right? For the haircutted, high quality liquid assets. And also we are here integrating the model with what we call a satellite model, right? So we have this main model, the ALM model, that views the financial institution as a whole, right? And calculate optimal decisions as a whole, thinking of the whole portfolio altogether, right? But we can also, this model can also coexist with satellite models, right? Local models that do optimization for local portfolios. So in this case, we have a local model for the liquid asset portfolio. It could be a mean variance model, let's say. So we are creating here an integration with this model by fixing the optimal weights of the portfolio in risk factors, of course, the optimal weights. So this is going to be an input to the main model, okay? All right, so in the liability side, we have the demand for savings and CDs. They follow the demand elasticities. We also have those ad hoc rules to the other products of our liability side. And of course, these could also be governed by demand elasticities, but we chose to illustrate some of the options you have when you are modeling the items of your balance sheet. So here we are going with some ad hoc rules, okay? So in terms of capital and risk, we have those rules. The first one is an interest rate risk limit for the trading portfolios in terms of DV1. We also have a interest rate risk limit for the banking book in terms of delta NII and EVE, right? So with a horizon of 1 year and a 200 basis points shock upward and downward, okay? So the model can also treat all the other cases of the regulation, right? So steepener, flattener, so on and so forth. But for simplicity here, we chose only to work with those two shocks. We also have a limit for the usage of derivatives. So we can prevent the model for overusing derivatives. We also have a foreign exchange exposure limit and a limit for LCR in terms of liquidity, right? And also a limit for capital consumption. So the common equity tier 1 ratio, it has a floor in our projections, okay? And so the main parameters of the model is that the number of steps is 12, right? So the model is going to have 12 stages of decisions, right? It's going to decide 12 times to roll over the portfolios and how to roll over the portfolios optimally. The step size is 3 months. So we are going quarter by quarter, right? And the objective function is to maximize NII, okay? So here we have, in the objective function, we have, of course, a menu of different options, right? So we could maximize NII, we could maximize growth of the asset side, we could minimize the cost of funds, right? So these are only some of the options that we have. And we can also work with a linear combination of those functions, right? So, and this linear combination can also vary over time because we have 12 steps of decision. In each one of the steps, I can have different weights for different objective functions, right? So imagine that in the short term, I'm more concerned about the growth of my bank, right? But once my bank has grown, now I'm more concerned about efficiency. So I'm more concerned about net interest margin or about net interest income, right? So we can also play with those weights in order to have a more complex goal for the financial institution. All right, so now I'm going to take a little pause to explain the technology that we are using in order to create all those constraints and in order to process all those inputs and create optimal decisions, okay? So this is an excerpt from our book, ALM Modeling and Balance Sheet Optimization, with what we call the banking problem. So for us, the banking problem is to maximize the profitability in a specific planning horizon, right? And respecting operational, regulatory constraints, and also taking into account the uncertainty, okay? And also the possibility of rebalancing portfolios over time. So in order to process all those requirements to solve the banking problems, we really think, and we have been working with the banking problem for years and using different technologies to tackle this problem. And we really think that the proper tool to address this problem is multi-stage stochastic optimization, right? Multi-stage because you have the possibility of rebalancing the portfolio over time, right? Stochastic because you have to consider not only the average case, not only the most probable case, but also the whole distribution of the risk factors when you take your decisions, right? And optimization because you have constraints and because you have a specific objective. Okay. All right. So we have different tools in the realm of stochastic optimization, but the one we have been working with and the one that we use in our ALM models and also we teach in our course is stochastic dual dynamic programming, which is like which can be classified as an artificial intelligence tool, right? In the category of Q learning or reinforcement learning. And this tool, it is being available in the market for decades, and it is widely used in the calculation of energy systems, right? In integration of hydropower with renewable energy, with all the traditional sources of energy. So how you can integrate those sources of energy and do energetic planning is, so most of the countries today use it at the national level, of course, uses SDDP as their tool for planning. And we are bringing this tool from the energy sector to the finance and to the banking problem. Okay, so this is an iterative algorithm. The algorithm is always learning better and better decisions, and the final decision, the optimal decision, we call it policy. So it is going to learn an optimal policy, how the institution should handle the risk factor, the realization of the risk factors over time, right? So all the decisions are conditional to the realization of the risk factors, okay? All right. So this is just a graphical intuition of the stochastic dynamic programming. So imagine here that we have in this first node, we have the current balance sheet of the bank, right? All the current portfolios, all the current positions, right? And the problem here is to project the balance sheet and project all financial statements for 3 periods, right? So we have three different stages of decision, but we also have, in this case, what we call a Markov chain. We have also different status of the economy, right? So the status could be bad and good, right? In this case. So in step 1, we could be in a bad state, or we could be in a good state. And then in the step 2, we can transition to a bad state, or we can remain in a good state, right? And in all these states, we have different probability distributions for the risk factors. So these are being represented here by these omegas, okay? So we can sample from the distribution of the risk factors in different states of the economy, right? And then we can produce different projections, so a handful of simulations of future balance sheets, of future financial statements. And we can also derive a policy, an optimal policy that helps the financial institution to take decisions conditional not only to the state of the economy. So if the economy is going to be good or bad in a year or in 10 years, but also the realization of the risk factors in a specific time frame. Okay. All right. So now we are going to jump to the results Okay, so I'm going to show some of the outputs of the model, and especially some of the pivots that we can do with the raw data that the model produces. And we're going to discuss some of the results, okay? All right, so the main products of this run, of course, is the set of financial statements, balance sheet, income statement, and cash flow statements, right? But with the raw data that the model produces, and it produces data at the most granular level. So some of the decisions that the model is going to take is going to be how much of each one of the contracts is going to be bought or is going to be sold in each one of the time steps. So, and what are the characteristics of those contracts, right? So we have the most granular level of decision, and we can do pivots with that granular solution in order to produce more insightful reports, okay? So one of those reports is the optimal funding mix. So this is the liabilities composition. So each one of those 4 bars here, the gray one represents the current balance sheets, the current position, and the 3 other ones are the projections for the first quarter, Q1, the second quarter, and the third quarter, of course, in a specific scenario that is being simulated in the simulation phase. Okay, so here we have the breakdown of the liabilities, of the optimal liabilities for each one of the periods, right? So it is a projection that can also be used in order to calculate the expected cost of funds, the cost of funds curve, and also be used in the FTP calculations. Okay, so another report here is a breakdown of the hedging recommendations of the model. So this is using the ALM strategy, the ALM hedging strategy for producing swaps deals, right? So all these swaps, they are bought or sold by the model in order to manage the risk, the interest rate risk, the foreign exchange risk, and also the liquidity risk. So we are considering those swaps also in terms of margin requirements, and they also impact the liquidity risk. So these are the recommendations that are being produced by the model. So in the first quarter, in the first stage of decision, the model bought a AFEX swap in order to manage the foreign exchange risk, right? A swap that pays pounds, receives euros. Here is the notional of the operation and also the maturity of the swap. So if we equip the model with a menu of different positions that the model can acquire in the future, so the model will decide to acquire some or other position, and this is going to produce a report of recommendations. All right. So this is the breakdown of the interest rate in the banking book, right? So we are using here the upward parallel shock scenario, right? With our delta NII and delta VE. So we have an upper limit here of, so this is multiplied by 100 in order to visualize to help the visualization. So we have an upper limit of plus 500 and a lower limit of minus 500. And we can see here that the model is always complying with the risk limits. And that is also taking a position here. It is also taking a direction here. Let's say that we have 2 options when we are dealing with interest rate in the banking book, right? We can immunize our portfolio or we can ride the curve, right? So the model here is choosing to ride the curve because we have set a band for the interest rate in the banking book. So the model took optimal decisions in order to maximize NII using the interest rate curve. but we can also tell the model to immunize completely the portfolio, or we can also decide what is the position what is the exposure that we want to have given our expectations on the yield curve. So we can tell the model, we can force the model to make that decision or to position in terms of IRRBB in a specific level. Okay, so these are some of the options you have when we are telling the model how to manage interest rate risk in the banking book. All right, so in terms of loan pricing, we have here a breakdown of the consumer loans new operations. So these bars here are the new volume hired for consumer loans, and in this line here, this red line, we have the overlays that the model decided, right? So the model decided for a 53 basis point overlay in the second quarter, and it gives us a new volume symbolized here by this bar. But in the third quarter, the model decided to lower the rates, right? So because it lowered the rates, it also had more volume, more new operations, more new loans entering in the portfolio. And this is being completely governed by the demand curves, the demand elasticities for consumer loans. Okay. On the other side, we also have the optimal prices and volumes for savings. So the non-maturity deposits here, and this overlay is being symbolized here by a percentage of the risk-free. So 96% of the risk-free is going to be the rate that we are going to offer to our depositors, right? And the more rate we decide, the quicker this total volume curve is going to increase, right? So these are also the decisions that were taken by taking into account all the business rules and also the demand curves for non-maturity deposits. All right, so this other graph here is a 100 simulations graph of the net interest income. So this is a cumulative net interest income in the first quarter, in the second quarter, and in the third quarter. So we can assess the distribution and also the different paths that the simulation took in terms of NII, which is the variable that we are optimizing in this case. And this is a breakdown of the third, of this third here, this third point here. So this is a breakdown of the probability distribution with a histogram. And we also have the average NII, which is 48 over the 3 periods. And we also have the quintiles that we can do earnings at risk calculation in our case. And I must say here that it is maybe the traditional way to calculate earnings at risk with Monte Carlo simulations. I think that this is more powerful than a Monte Carlo simulation because it allows for conditional rebalances over time, right? So it usually produces a not so how can I say, not so fat tails on the distribution of the net interest income. Okay. All right. So we went, I think, 40 minutes of presentation. So I want to thank you guys for listening and for staying until the end. And now we are going to take some questions. So I'm going to hand over to Diogo so we can take a few questions. Thank you.
Well, thank you very much, Lucas. Thank you, guys. No one used the Q&A session, but I have here Brian and Vinicius that hands up. So I will open the microphone here just for help us. Just a minute, please. Oh, sorry. Let me see the Q&A session here, if someone uses it, because I have some. Okay, we have a question here from Niranjan Sambus. Thank you. The balance sheet as well as markets are dynamic. How do you manage this? The balance. So, okay. The question of Niranjan is the balance sheet as well as markets are dynamic. How do you manage this? So if we got your question right, Niranjan, what we do is basically when we build a model, you have to provide to them a lot of scenarios. And in these scenarios, we can express the market dynamics in terms of the volatility of the risk factors, the volatility of the multiple behaviors that appear in different lines of the balance sheet. So we can tell to the model that there are a lot of things that change over the time. So that's essentially the idea of having that architecture that Lucas showed. That it's basically a graph where we have a lot of possible transitions and different distributions for all the risk factors involved. So is using this layer of the modeling process that we tell the model the markets are dynamics. So when we train the model, these dynamics of the risk factors and of the behaviors, they are being taken into consideration. That's the idea.
Diogo, can I also add something?
Yes, please, Lucas.
Okay, so yeah, I think this is a very good question, and I think that the characteristics of the solution of the technology to have conditional decisions, I think it is very important if you have a dynamic market, if you have risk factors that are changing over time. So the model is going to produce a solution that is conditional to what is happening at that moment. Okay, so I think this is also some of the best ways to handle a dynamic optimization. So we like Diogo said, we will supply a full distribution of the risk factors, but our decision is going to take into consideration the full distribution, but it is also going to be conditional to what the realization of the risk factors are in each one of the time steps.
And Lucas, I think if we come back to the graphical intuition slide, I think we can make ourselves yeah. So that's it. What the model produces is conditional decisions at each stage and stage. And so it's also dynamic in this sense. The response the model produces is not the same. It depends on what's happening in the market and what's going to happen in the future also. That's very important also to communicate here. So we have another question here from Brian. That's regarding historical data. The data was historical or assumed in this exercise. I'm assuming you are talking about this exercise. So this is a hypothetical exercise. It's not real trajectories of risk factors that are showed here in this simulation, but we can use in a real implementation, a real use case. We can train the model, use historical scenarios, but you can also train the model use a scenario generator. So you can have a historical data, you can fit a multivariate model that is able to generate a lot of scenarios, and then you can train also in these synthetic scenarios also. And another very important aspect of these technologies is that it allows us to perform some out-of-sample simulation. So you can train the model using part of your historical data or part of your simulated scenarios, and then test the performance, the policy performance in a different test sets. So it's basically the same philosophy we are used to see in this AI universe. You can separate your data sets, your historical data, one part for training, another part for testing the strategies. Another very interesting way of use the model is the same, basically the following. It's very common in the stress testing exercise that the regulator will provide you some scenarios, provide a base scenario, provide some different stressed scenarios. So you can train the model, use your historical data, your scenario generator, and then we can test the performance of your model using a complete out of sample that was not generated by you or by your team, but instead they were provided by the regulator. So this is a very interesting feature that enables us to produce a really fair simulation. Because when we are building this type of model, we are always in danger of looking at the future, looking at the data, and then fine-tuning the strategy to perform well in a scenario. So sometimes people do this without noticing. It's really a bias we have. So using this separation of test sets and training sets, we can kind of prevent this type of problem. So it makes the model more useful and more safe to use in this context also. So we have another question here. So a lot of questions. No, now we have a lot of questions. Let me let me organize this.
Okay, let me take one here.
Okay, Lucas.
So one from Brian. Thank you for the question. Should the frequency of the model be monthly or quarterly as an optimal review? So this is also a rather interesting question because in these dynamic programming models, we have some degree of what we call the curse of dimensionality. So the more steps we add, the more stages of decisions we add into the model, the bigger and the bigger the infrastructure is going to be required to run the model in a timely manner. Okay. So yes, you can have the model as granular as possible, right? So this is this could be useful, but if you choose the model to have many steps, maybe you will have difficulties in solving the problem. Although the stochastic, although the dynamic programming is a technique that is created to handle bigger problems by breaking those bigger problems into sub-problems. But we also have some degree of curse of dimensionality. So at the end of the day, you have to choose from your experience what is the frequency, the rebalancing frequency that is useful for your case, right? But what I want to highlight here is that you can also use different frequencies for different horizons, right? So in the short term, you can be more granular. You can have you can rebalance more frequently, but in the medium and long term, you can have wider intervals. So in that way, you can both have and eat the cake, right? So that is a rather interesting question.
I think we have another question from Venetia. I think it's a very interesting question because it talks about the pricing and pricing derivatives and pricing models. So for the pricing of the vanilla derivatives, each bank has different models. Do you get specific bank models to implement the models, or you use your own models? So what's the idea here? During the model building process, we need to calculate what we call the model coefficients. What are the model coefficients? Model coefficients are basically cash flows, prices, accruals, sensitivities. We have a lot of things to be calculated in order to enable us to build the model. So that's in this phase, we need to connect the model with the pricers. So we don't price derivatives within the model. We take the pricing as an input. So we simulate scenarios when we need to have a pricer that will calculate the price for a given derivatives, how much cash flows it generates in each time bucket. So we use these quantities in the formulation of the model. So in other words, the idea is to connect the balance sheet model with these satellite models that are responsible for calculating the price. That's basically the architecture. Anyway, it's worth mentioning also that we need to perform a lot of calculations when building this type of model, because we are doing a forward calculation. We have a lot of states, so things become very expensive in computational terms. So in a real application, we need to have some caching schemes to perform these calculations very fast, because we need to repeat these pricings a lot of times in a lot of scenarios. So, and in some cases, the pricers can be very expensive because some derivatives, we have some Monte Carlo simulations to price a derivative. We have some other simpler models that are based on analytical formulas. So we need to work with all this universe and try to find strike a balance between accuracy and performance, because when we want to optimize the whole balance sheet, you need to do some simplification, some contract aggregation. So it's also important to understand what's really important for the whole picture. So maybe we have a very complex derivative that takes maybe 10 minutes to be computed, but represents just a very, very, very small part of our balance sheet. So you can simplify the calculation within the balance sheet optimization process. That's basically the idea. And so let's see, we have...
Let me take one.
Okay, please, Lucas.
So this is a question from Femi. I hope I'm not butchering your name. Sorry about that. And from a liquidity perspective, can the model consider both LCR and NSFR as part of the constraints, or is it limited to just LCR? Yeah, in this case, we only used LCR, but there's also, you can also implement NSFR calculations in your model, and they can work both together, right? So like we are, let's say, using two different views for the liquid assets portfolio, the liquidity risk, right? So we have in our example, we have both a liquidity floor, only looking at the high quality liquid assets, and flooring, the haircutted portfolio. And we also have the LCR working in combination with a liquidity floor. And we could also take let's say a more medium-term view and use LCR and use NSFR in conjunction with LCR and the liquidity floor. Yes, this is also possible.
We have we have a question from Mukund Haveri. What does replication portfolio means in the context of non-maturity deposits for IRRBB and liquidity risk? No, that's a very interesting question. The idea, usually what a bank does to represent the term structure of the non-maturity deposits is to create what we call a replicating portfolio. That's basically a portfolio of fixed instruments, a hypothetical portfolio of fixed instruments that emulates the term structure of your deposits portfolio. So because since you don't have a contractual maturity, what we do is to kind of estimate behavioral model. So the replicating portfolio can be saw as a maturity, as a behavioral model that it's a base for you to land in the other side of the balance sheet. So it also is used to in the IRRBB calculations and in the liquidity risk also calculations. So it's basically a term structure representation of your deposits. And since you have this representation, you can enter this representation in the IRRBB formulas and in the liquidity formulas also. That's basically the idea. And it's very interesting also to mention that you can have different replication portfolios conditional to the level of the rates. So that's very interesting point, because these kind of deposit betas, deposit replication portfolios, they are not static they are not independent from the rates. So since you have a stochastic model, you can have different replication portfolios that will be used within a given scenario, within a given market condition. So the optimization will take these dynamics into consideration. I think also connects with the question made by Niranjan at the beginning, because this is a thing that's really dynamic, and it leads bank to bankruptcy. So it's important to have this part of the balance sheet fluctuating according to the rates. It's very important to have this for IRRBB and for liquidity purpose also. I think we have some time to more questions.
More, Diogo?
Yes, please, Lucas. Go ahead, please.
Okay, so I'm going to take a question from Ashish Nigam. I hope I'm not mispronouncing your name. Can this model be used in real-time scenarios? And how does it evaluate liquidity and interest rate risk? Okay, so these are two questions here. So I'm going to take the second first. So how does it evaluate liquidity and interest rate risk? So each one of the contracts that the model has, access to, right? We have the risk calculation in each one of the scenarios, each one of the possible scenarios. So let's take a look here at this diagram. So for each one of the realizations of the risk factors, for each one of the scenarios, each one of the stages, and each one of the states of the economy, we have a different level, a different risk level for each one of the contracts, all right? So this is a very heavy calculation, you must imagine, right? So we do this calculation for each one of the contracts, and then we aggregate those risk metrics based on the decision that the model has taken. So imagine that the model decided to buy 100 units from contract A and 200 units from contract B here at the stage 1. So the risk metric is going to be a linear combination of the number of contracts that I have bought for each one of those contracts. Okay, so this is valid for all linear measures of interest rate risk and of liquidity risk. Okay. And the first question, can this model be used in real-time scenarios? Well, it is commonly used in long-term planning, right? So I don't think it has use cases of real-time usage. But what I must say is that it is a challenging and interesting view of how to use those models, and because it has a training phase, like an AI model. It has a training phase and it has a simulation phase. So what we can do in order to achieve, let's say, a real-time evaluation is to pre-train the model, right, and create the optimal policies, and then we can use the model to evaluate what is happening on real time, right? But the training phase, which is long, which takes time, because, like I said, we have to do multiple calculations for each one of the contracts, each one of the stages, each one of the states of the economy, so we can pre-train the model like an AI model, right? A traditional neural network model. We first pre-train the model, create a optimal response, and then we can only use that model to produce, let's say, real time. I don't believe in actually real time, but we can for sure speed up the calculations by pre-training the model.
Another very interesting question here is if it's possible to incorporate the full set of latest regulatory requirements from EBA guidelines on IRRBB, CSRBB, and etc. So yes, that's the idea. What we are showing here is just a use case. We have a example of constraints, but the model architecture, the most fundamental part of the model are decision variables and other auxiliary variables that represent book values, cash flows, accruals, and other more fundamental quantities that can be used to express virtually any type of equation and that to code these new constraints. So let's say they changed the size of IRRBB shocks. That is a current topic in the industry. So you can do this. They created a new constraint on NII. You can also do this. We have a new threshold for outliers from an EVE perspective. So you can also add this, and even constraints that are internal to the organization. So you can have some budgets for different business lines. You can also add these budgets. So the optimization will try to match all these targets. So if you don't want your mortgage portfolio, for instance, to be greater than 50% of your assets, so you can add this type of constraint, and it's virtually possible to write every type of constraint, since you can fit the constraint in the technology we are using. So in this case, we are basically using linear programming, but you can also use this type of technology with quadratic programming. So if you are able to represent the constraint, use this type of equation, it's possible to incorporate into the models. So I think we have other interesting questions from Niranjan regarding this slide also. If the model infer the probabilities of the next steps, or if the model use provided a priori probabilities. So the idea is that we provide the probabilities. The model does not infer probabilities. The probabilities is a characteristics of the historical data or a scenario generator. So you must provide the probabilities. But you can have different probabilities space. Let's say let's put in these terms. You can train the model using a a set of probabilities, and then you can, if you can shock the probabilities and do your out of sample test using another probability space, let's say. So it's kind of testing if your scenario generator is broken. In some case, you can add enhance, improve, and increase the probability of a stress scenario, or change the probability of your base scenario. So it's possible also to do this when we are playing with this out of sample feature that the model provides. I think we have another similar question from Larissa Miyagi. What tests do you do to evaluate the performance of the model? So that's when we run the model, we can we basically forecast and project all the balance sheet lines, and then we can compute virtually any type of profitability measure of return on capital, return on equity, NII, net interest margin. So you can choose your set of performance measures, and then you can track this in the simulations, the best case, the mean case, the worst case, and then we can compare this against a benchmark also. If you have a benchmark, so you can also do this type of thing. And as we recommend, this test must be done in an out of sample way to have a more safer results. But that's basically the way to test the performance of the model. So we have another question. How do we ensure confidentiality of bank input data? Is there an offline version of the tool provided to the customers? So this is a very hot topic. The model really needs to consume a lot of data about the runoff portfolios, data about business plans, data about risk limits, data about everything that is involved in the bank evolution over the time and over different scenarios. If you want to have a useful forecast and useful simulation, you need to have access to this type of data. So we depart from the principle that treasury is the heart of the bank. So it needs to have access to the cash flows, to the strategies. So if we don't have access to this type of data, we cannot plan in a proper way. So here it applies the same controls. Now you must apply the same controls you have for protecting data to avoid the data to be disclosed to an appropriate publics. So that's basically the same idea. Let me see. We have one more question for Brian. I don't know, Lucas, if I got it right. Does the model take this into account after the fact data? I mean, applying Bayes rules. It's a very, I don't know if I got the question right. But when we train the model, we must provide a set of scenarios, or they can be historical scenarios, they can be generated synthetic scenarios. And then we can compare. We can compare what the model produce in terms of performance, in terms of strategies. We can compare in the future when we have the scenario realized. What was the prescriptions, model prescriptions, if it was observed a given trajectory. So can do this. There is no limitation to test the performance of the model using any type of scenario. So you can train the model and then test the performance in a given scenario that is the scenario that come up to be realized in the future. So you can do this, but it's not a probabilistic exercise. I mean, it's not about applying some type of Bayes rule or any kind of. It's just more a back testing exercise. I mean.
Can I add something, Diogo?
Yes, please, Lucas.
I think that the way the model updates the probabilities, instead of a Bayesian scheme, I think that in this setup here that we have in the diagram, it uses more of a Markovian way of updating the probabilities. So you have multiple transition probabilities, transition matrices, right? And then these matrices, they govern the leaps between states. In this case, we have only two, but we can have multiple states, and we can have bigger transition matrices. And the model uses those leaps to update the probabilities, the distribution, probability distribution in each one of the nodes and each one of the cases, right? So I think it uses more a Markovian framework to do that.
So I think we try to handle all the questions. Okay, I think we have one more question. Let me see here. Oh, thanks, Niranjan. Thanks. So we hope we have enjoyed this webinar. We are really enthusiastic of this topic. So feel free to reach out to us whenever you want to talk about this. It's very important for us, your engagement in our posts about this topic. We learn a lot with you guys. We have very different perspectives of the banking problem. We work in very different types of organizations. So the dialogue with you is very important for us. So thank you a lot. As Lucas mentioned at the beginning, we also have an online training on this topic, ALM and balance sheet optimization, that's going to the second cohort in this September. We are running a first cohort with around 30 students, I guess. And it's been a very, very nice experience. So it's a very dense course in which we deliver not only the theoretical aspects, but also a lot of code, a lot of prototypes that can use as a shortcut for the implementation on your organizations. So we invite you to know us visiting our website. And if you want to have more information, feel free to reach out to us. And thank you very much for our presence here today.
Thank you. Bye-bye. See you guys.
Bye-bye, guys.